Okay, we've got an apology from Councillor Guy, and I'll move that that be accepted. Is that a second, Bill? All those in favour? Aye. Carried, thank you. Are there any declarations of conflicts of interest that we're not aware of that need to be continued?
I will declare one for item 8, the sale of councillor iPads.
Right.
Obviously, right.
Yes.
Could be affected by that. So.
Okay.
Well, I haven't said I'll take one yet, but you could think you go.
Yeah, right. So thank you. Right, moving next, there's no matters lying on the table, and there's been no one wanting to register to speak in the public forum. So confirmation of the agenda. I'll move that the agenda be confirmed without addition or alteration. Is that a second for that?
The only thing I was going to say there was that there was a note about the page numbering.
Yeah.
That page numbering's still not. I think it still starts at 7. I think.
Yeah.
Yeah. So if there's any confusion about which page we're referring to, that'll be.
We'll clarify as we go. Okay. We've got a second that? Your second?
Yep.
Yep. Thank you. All those in favour? Carried. Confirmation of the public minutes of the meeting on the 8th of July. Be confirmed as a true and correct record. You'll be moved and seconded by Bill. All those in favour? Carried. Thank you. Right. The next item is we've got risk and compliance update, and Gareth's joining us on the fire.
Good morning, Chair. Good morning, members of the committee. Firstly, apologies that I'm not with you this morning. I am currently in Sydney and preparing for underwriter briefings this afternoon. So I will give you an update around the insurance component in the second item. With your permission, Chair, I'll just take the committee through 3 recommendations very briefly, touch on some key points, and as usual, happy to respond to any questions that the committee may have.
Thank you.
So just a reminder, the purpose of this report is to provide a governance update in terms of the Queenstown Lakes District Council risk context and the overall programme. Today we have 3 recommendations. The first is note the content of this report. The second is seeking feedback from the committee. We were asked by the committee to come back and I did say I would give you an update at this meeting. We have pulled together a template for essentially a second line assurance map. You'll see that that also includes the program of internal audits, and Mariano's programs in there as well. So I'll take you through the structure of that very briefly shortly. And the third recommendation is for the committee to recommend a compliance management policy to council for adoption. This is the first time we have proposed a compliance management policy. So also keen to get your feedback on that policy. So with your permission, Chair, I'll just take the committee through those items very quickly.
Yeah, thank you, Gareth.
So points 3, 4, 5 and onwards in the report, there is an update on the current context that the council is working in. You'll see there that there's been 2 changes in terms of tier 1 risks. The first of those is a tier 1 risk around unexpected change in cost or funding. That had been one of our very high risks until recently. We obviously have responded to that. As you'll see in the report, there's a number of treatment plans connected to that, and we have now reduced that from very high to high. Obviously still some work to do there. Some of the treatment plans that we currently have put in place are yet to be embedded. So we'd expect to see a further reduction in that risk rating as those treatment plans come into effect. Second risk is the risk around ineffective governance. That has been reduced from high to moderate. We obviously through the governance team have done a significant amount of work, particularly in terms of induction for the new council. And with that in mind, given the standard and quality of that induction, that risk rating has been reduced to moderate, as I said.
Yeah, Gareth, there was a question from Lisa just to me around the reduction in the risk rating. And I'll just confirm the level of confidence dropping the risk rating on risk 10015 on effective governance is robust. So I'm just asking that question on behalf of Councillor Guy.
Happy to respond to that. I mean, in reality, there's a number of treatment plans also in place in regards to that risk. I'm comfortable from a risk perspective that in seeing those treatment plans in place in preparation for the new council, that moderate is a reasonable position for that risk to be in. Again, there still needs to be some work in that space, and obviously there's some intent to work with the new council around improving any concerns there are around governance. So from my perspective, in response, happy with the moderate rating.
Thank you.
So I just want to touch very quickly in terms of the work of my team. I think there is a fairly significant improvement in terms of our risk register. So I just wanted to touch on that. That hasn't gone live yet, but is due to go live in the next couple of weeks. I have on a number of occasions talked about our continued improvement in terms of, one, the maturity of our risk culture, but also two, how that's supported by our risk register functionality. So until this new upgrade of the system goes live, I and my team were the only people in the organisation that were able to make changes to the risk register. The process, as I've described previously, was that I had quarterly meetings. I still intend to do that, but at my quarterly meetings with Tier 3 managers, I would talk through each of their risks. Their team members would attend as necessary, and we would discuss treatment plan activities. I then had to make all of the changes in the risk register. What that has meant from a risk culture perspective is that for all intents and purposes, there's some intense periods of changes in the risk register. Each time I meet through those quarterly meetings, we make changes, and in between those meetings, although changes have made, obviously they're less significant in terms of volume, and that means that in all cases we're not quite reflecting in our risk register the current status of risks. So the changes to implement workflow, that's now being tested and ready to push live. That will enable anybody across the organisation to do two things predominantly. One, propose changes to existing risks, and two, propose new risks. In both of those cases, any proposed changes come through my team for review and then on to the relevant manager or risk owner. The same process applies for treatment plans and also treatment plan tasks, so similar workflow. Obviously, the importance of that is not necessarily the system functionality, it's more around the fact that we push the ownership of changing risks and updating information and making that live to everybody across the business. So I think that's a fairly significant change for us. I just then wanted to touch on the two attachments to the report. The recommendation obviously talks to both of those. Firstly, the attachment B, which is the proposed second line assurance map. As you can see, the second line assurance map is essentially a table which outlines each of the various levels of assurance, second and third predominantly. What we've done in that map is principally we've started with financial assertions in terms of what we might like to see in terms of controls, or what we would expect to see in terms of controls. It then incorporates in information around the relevant risks in our risk register and looks at what other controls might be expected, or what other controls we might expect to see, I should say, in regards to those risks. You'll see that the structure of that obviously matches each of those different areas of second line assurance with the relevant risks in the risk register. And in some cases, there's multiple, so we've tried to pick the principal risk. It provides information then around what the expectation would be for first lines and managers and their teams in terms of making sure that we're implementing those controls. That's blank at the moment. This is just a template. Obviously, we will complete that afterwards. It then goes on to obviously the second line control. So the controls that we would implement from a risk perspective to give managers and governance assurance that we are implementing those controls at the first line and obviously reviewing and detecting any failures in those controls at the second line. And then on the right-hand side, you can see that we've matched those with our internal audit program, which is already mapped to risk, as we've outlined previously. And then further to the right, the last column outlines where those controls are also tested through external audit via Deloitte or some other form of external audit. Just a couple of things to point out, and again, seek feedback from the committee on. At the bottom of the table, so the very bottom left-hand corner, we have a TBD, to be determined. So keen to get some advice and guidance in regards to those. We have flagged business continuity planning. We have some risks on our risk register around business continuity. At this point in time, we're unclear exactly how we would reference first and second line assurance in this assurance plan. Similarly for emergency response. And then the third TBC that we're keen to get some feedback on is fraud. So at the moment, we've taken the approach that controls across all of the assertions from a financial perspective, as well as some of the other controls in terms of behaviour and culture, obviously interact and reduce the risk of fraud. We haven't got a specific line item in this second line assurance map. So again, keen to get some feedback from the committee on that.
Right. Any questions through that first part? Keith.
So just one, Gareth, the changes or the enabling others to make changes to the risk register, what controls you got in place just to make sure no one's in there making them, or so that you know they'll be made, I guess,
Yeah, really good question. It's an important function of the system. So the system itself has workflow built in. It's a Tech One system, so it's similar to our other financial workflows. If someone proposes a change, they have to submit it for my team's review. We can do one of three things predominantly. One, accept it. It then goes on to the approver. Two, accept it with changes, or three, decline it. All of that functionality means it sits in I suppose, a ghost version of the risk register until it's either approved by my team and then either the relevant manager or the risk owner.
Thank you. Kevin? Okay. Right.
If there's no more questions on the second line assurance map, Chair, just very briefly, I'd like to just touch on the compliance management policy, if that's okay, given that it's new to the organisation. I don't intend to take too much time on it, but there are some core components that I'd just like to touch on.
Thank you, Gareth.
So the compliance management policy, as I said, is a new policy for the organisation. It covers off three areas of compliance, or three types of different compliance categories. That's external mandatory obligations, so obligations that come through either directly from law or come through via consent or some other form of authority. It covers off voluntary external obligations. So voluntary external obligations are ones where QLDC has publicly adopted a standard, for example. That might be an ISO standard or some other form of authority that then places some obligations on us. So that's the external voluntary obligations. And then internal mandatory obligations. The internal mandatory obligations for QLDC are obligations that are imposed through policy, and often those policy obligations map to external mandatory obligations. This proposed compliance management policy sets out a framework for that. As I say in the report, principally, external mandatory obligations, as outlined in this policy, is existing process. So I have talked to the committee on a number of occasions about the obligations register that's circulated to the business and the response that the business makes in terms of reviewing that and confirming that they have systems and practices in place. That's intended to stay as is, but is obviously now outlined very clearly in the policy. I've placed through this draft the obligation on general managers to identify any voluntary external obligations. Obviously, the risk team would find it difficult to identify all of those. So there is an onus on general managers to do that. And then thirdly, internal mandatory obligations policies. As we've touched on previously, we have done a review of our policies across the business. We have several policies that are overdue a review, and we're working through that at the moment. The intent here through this policy is to provide space for us to embed improved policy practices before we require the documentation of obligations within a policy into our obligations register. So that's a future requirement for December 2027. So that's broadly the three main elements of the policy. Obviously, there's a lot of context there in terms of setting out the importance of making sure that we comply, making it clear that for external obligations in particular, we have an expectation that staff will comply with external obligations, and we have approach to deal with any non-compliance where it exists.
Questions, Bill?
Thanks, Gareth. First of all, I acknowledge all the great work you and your team are doing around risk and assurance, QLDC. Obviously, you don't want to use blunt instruments to drive culture. And this is a question both for this compliance management policy and the work you're doing around the risk register. Do managers have KPIs around risk and assurance that cascade down? Not that you want to use those as blunt instruments, but sometimes you need to incentivize people to focus on it. So will there be KPIs and managers' contracts around risk and assurance? That's probably my key question. If not,
really good question. And we're actually going through the process of implementing requirements to have KPIs regarding risk. We discussed that last year and made a decision that our focus still needed to be on health and safety in terms of mandatory risk-related KPIs. This year, we've made a change to the system. So managers are encouraged to identify KPIs relating to risk. And we have that conversation when I speak to managers at our quarterly updates. In the future, we are considering mandatory KPIs in terms of risk management, to answer your question. So it is, as you say, it's not intended to be a blunt instrument. We're always improving our culture. Last year, we didn't have a requirement. This year, we have an optional obligation in terms of KPIs. Going forward, we might seek to have a mandatory requirement in terms of risk KPIs.
Okay, thank you. Any other questions, Gareth? If not, I'd just like to endorse Bill's comments, Gareth. Some very good papers here and some great work going on. So well done, you and your team.
Thank you very much.
So we've got a resolution here. So noting the contents of the report, recommend that officers incorporate any feedback of the Audit, Finance and Risk Committee into the second line of assurance template, and recommend to Council that it adopts the proposed compliance management policy. Bill and Heath, your second. All those in favour? Carried. Thank you. We've now got the insurance update. Is it Bridget?
It's me this morning.
Yep.
Thank you, Chair.
You did say that.
Yeah, and I suppose I should start with just a very brief update of why I'm not on the call. So as I said earlier, I'm currently in Sydney, representing the South Island Council Collective. South Island Council Collective is 8 council organisations. It includes unitary authorities, Tasman and Nelson at the very north of the South Island, right down to Regional Council of Environment Southland. We have that collective policy for the purpose of catastrophic event. So principally, think flooding and earthquake, although it covers some other catastrophic events as well. It's separate from our material damage policy that considers a broader range of perils. Principally, that's the November renewal in terms of significant policies that we're currently working with our broker Aon on seeking to get the best out of a softening insurance market. as a result, I have been in discussions and presentations with Lloyd's of London, a number of underwriters that work out of Lloyd's. We have also had conversations with the Singapore market. There is capacity coming in from Singapore, and that's an option that we want to consider to diversify our insurance pool. Currently, in Sydney to brief underwriters in Sydney this afternoon after this meeting, and met with a number of local insurers in Auckland yesterday. So just to provide some context in terms of the preparation of this report, there is a significant amount of work being undertaken, one, to understand what our requirements are for catastrophic events, principally insurance, infrastructure, underground assets, but also to consider what that means for a potential water services entity. New Zealand currently has a strong history of a number of collective agreements for insurance. Worth noting, obviously, with the change to the delivery of water services, that places some questions around how we might manage that under agreements going forward. So we're also working to understand what that looks like. I'll take most of the report as read, but with your permission, Chair, I just wanted to give an update on a couple of sections of this report, which, since we presented the report, have actually changed through some of the work that we've done with our broker and also our General Manager, Catherine, who's in the room. So if I can take you to points 9 and 10 in the report.
Yes.
So point 9 states that through its broker Aon, the collective is seeking to remove existing sublimits from the infrastructure policy. So I suppose the first thing to note then is we are in a suffering market. So there's always a softening, I should say, market. So there's always a balance between, do you take reduced premiums or do you take opportunities to improve your cover? At the
latter.
I was going to ask that question, so thanks for that feedback. I suppose our current approach in working with the General Manager is to do a mix of two things, and I just wanted to set out the reason for that. So firstly, sublimits. Sublimits obviously mean that if we have a loss, we have a specific limit imposed on that loss. There's then a program limit across the policy. The original intent, due to the softening market, our broker presented to us the option to remove sublimits. That obviously reduces some of the constraints around sublimits for each of the different council. Obviously, we're still constrained by the information that comes through from our loss modelling. However, in feedback from the market, particularly Lloyd's, the Aon brokers raised questions around the fact that that is obviously not going to bring to us the premium reduction that we might expect. So we're currently taking two options to the market. So we're going to ask initially for them to price with sublimits, and then we're going to ask them, after they've done that, to price without sublimits, so that we can see what the different cost is in terms of implication for premium. The second component is in terms of reinstatement. So once we have a claim, Bridget, who works in my team, Bridget Allen, she's our senior insurance advisor, has asked some questions around how that works. The existing policy wording, to be honest, was a little bit unclear. Aon took that away to have a conversation with the team around how they could provide clarity. It's now intended that we have a reinstatement process at no additional premium. So it's an each and every, which gives us obviously a significant reduced risk in the case of multiple insured events. Understand from the market that might be something that's reasonable, favourable to us. So just flagging that the intent is to do, I suppose, one of two things: take the opportunity where we think there's benefit to improve our insurance cover in the relation to reinstatement, and secondly, obviously, to maintain sublimits for now, not seek to obviously change that risk, but obviously take some premium improvements across the South Island collective. So just wanted to touch on those. And then on a minor note on 10, there is a typo in 10. So my apologies for that. We have got an R at the beginning of earthquake that shouldn't be there. So
Yes.
we can note that that needs to be corrected as well.
The wreath, what is it, a wreath?
They're very serious.
That's right. Well, Mike, you looked through that in Christchurch with the reinstatement.
We certainly did, and equally quite a bit of pushback at times from the government about the quality of the reinstatement that the council is actually undertaking.
Yes.
So it sort of seems to cut both ways in some respects, but I mean, it is, it's a very significant part of our ability to get ourselves back on our feet.
Yes.
So having good quality insurance for that and good coverage is important.
Thank you. So I'll open up to questions, Kevin.
Yeah, just two quick questions. Firstly, did it say in there how long has the collective been in place and we've been part of it?
Yeah, really good question. I'm afraid I don't have the exact commencement date, but we're talking about a decade, out to 12 years, about that period, and that's the case for many of the collectives across the country.
And my second question is there a consideration, or does it potentially affect the premiums? Given the consideration between the different risk or natural hazards profiles for the different district bodies.
You see that with Western, where they've got the $1 million deductible.
Right. Does that apply
So
to
there will be specific things to be used.
Just, some of those districts have experienced a lot of issues recently.
Lot of
and we've
rain.
had a few premiums.
Yeah. I think, Gareth, I don't know if it's worth commenting on, obviously, when this collective was commenced, QLDC was a very different council to what it is now, where we've got a significantly enlarged asset base, where, along with Nelson City are by far the most urban of the two councils in the collective. So we are always, I suppose, wary of what is our weight in a collective like this, and that we're not overexposed or underexposed through that process. So I'm not sure, Gareth, or Catherine want to comment on that, but it is a live issue that we do sort of pay attention to.
Yeah, happy to add to that, Mike, and it's a really good point. So as I said earlier, we have to continue to look at our options in terms of cover. We do have claims across our collective. We haven't, touch wood, had claims. Most recently, we've had fairly significant claims associated with flooding events in Tasman. They had rainfall that was worse than anything they'd seen for 150 odd years. So significant there. And one of the questions that was repeatedly asked by underwriters was around Tasman claims when we talked to London, when we talked to Singapore. Obviously, that implication for us across the collective means that we are looking at two very close together flooding events. They happen within 10 days of each other in the Tasman part of the world. So yeah, absolutely. Does that affect premiums? Yes, claims will always affect premiums. And we've been reasonably lucky for a period of time to only have minor claims. So this is the first time we've had fairly significant claims coming in from Tasman, and that will impact upon our premium, which is why, as Mike said, we're looking at options for different approaches to assurance all the time. And we're meeting with the chief executive next week, I think it is, Mike, to take him through some options in that space. I'm not quite ready to present anything yet to the committee, but obviously will in due course.
Thank you. And well, one follow-up question, if I may.
Yes, you may.
On that basis, then, do we have any sort of higher level cooperation between the different councils, say, to look at how they're dealing with the potential for those natural hazards, and whether, say, Nelson or Tasman are treating their stormwater issues the same way that we might, so that we're all on a sort of a similar page of thinking in terms of managing those risks before it becomes a claim.
So collectively, I suppose, in terms of response to that question, first thing to note is that we're currently working with the other members of the collective agreement around agreement between councils. For 10 years, we've not had that agreement. So that imposes a number of requirements or in agreement on each council. So that covers off our approach to loss modelling. It covers off our approach to understanding the implications of that. It doesn't impose any obligations in terms of responding, but there are broader obligations on the likes of regional council to deal with some of the flooding risks. What we presented to the market when we took our presentation to the market was a number of upgrades that are going on across the collective agreement, including works in Tasman, Nelson, West Coast and Environment Southland. So I suppose to answer your question, while we have no agreement imposing a standard for responding to these to reduce risks, there is work underway, and we do have a collective agreement to make sure that we're clear in terms of consistent approach to dealing with things like loss modelling and the impacts.
Thank you, Gary. Bill? Yep. Just like to acknowledge council again for the leadership was shown around the South Island Collective. So I think it's a great initiative. Good that we're showing that leadership. I don't have any questions really on what Gareth's covered, other than it's been comprehensive. It felt well informed. It's been a while since the Canterbury earthquake, and I'm just thinking to myself, where does the QC fit in this insurance picture now? Do we still pay levies as a council? So what is the role of the QC with earthquake insurance these days? Not sure. Yeah. Do you know, Gareth?
I don't have the detail in front of me. Happy to follow up after the session with that. I know that there is a role, specifically what that role is and how we might be covered under that. I will ask Bridget to incorporate that into assurance strategy, so it's clear when we bring that back.
The reason I was triggered by paragraph 14 and doing some extra ground parametric earthquake insurance. I've just made me think, well, is the QC still playing a role? Councils and other institutions and homeowners still paying the levy? And what is that used for? Yeah.
Yeah, it's a good question. I'm sorry I don't have a response, but I'll get one for the committee.
Thank you, Bill. Nothing. Okay.
All right, we've got to note the contents of this report. Note that the Chief Executive will use his delegation to negotiate the November 25 insurance renewal within the 25-26 insurance budget. And note that Queenstown Lakes District Council's Audit, Finance and Risk Committee gave authority to the Chief Executive at its 27 June 24 meeting to enter a contract for insurance brokerage services with a projected insurance cost over the 3 + 1 year term expected to exceed 12 million. So I'm happy to move. So we'll second. All those in favour? Gary, thank you. Thank you, Gareth.
Thank you very much.
Treasury update. The Paddy, Miles.
Presentation.
Aye. The latest one. Yes.
Right, morning all, morning chair, morning committee. So Scott Miles here now just to give us an update of where we are with the Treasury.
Thank you, Mr. Chairman. Pleasure to be here again. Look, this is just a wee bit different what we're doing today because you know, the problem we've had in the past is that what we've presented is historical, just because the report was written not on the original report was written, I think, in mid-September, 16th of September. Just quickly, are there any questions from that report? I don't think there's anything too earth-shattering in it in the e-policy compliant. No, okay. So I just thought that we could go through this presentation because it does provide an update. And it's, you know, at the moment, obviously, things are very fast moving and very fluid as far as the financial markets goes. But I could spend probably the next 2 to 3 hours talking about this, but how long would you like me to talk for? 15 minutes. It's reasonably important, I think, what's going on at the moment in the context of what's happening with the debt at 700 million. This is the US, so this is the New Zealand and US 10-year government bond yield, and you can see that New Zealand's in black and the US is in red. Now that big V that you've got sort of in the middle of it, you know, where rates went up very sharply, those were the Liberation Day tariffs. Can you just point to that, Stuart, please? The V. Yeah. Yeah, that one there. So both New Zealand and US rates went up very sharply on the day that the tariffs were announced. The US 10-year was at 3.88%, and within a day and a half it was at 4.5. Now that was the biggest. The bonds trade in morning and afternoon sessions. The afternoon session after announced was the biggest session move in 38 years. And then you can see that rates have generally come down and New Zealand has followed suit. But the interesting thing here is that if you look at the very right of the graph, you can see that the US rates went up and New Zealand actually came down, or well, no, they actually have come down, but this is just in the last 10 days or so. And the reason for that is our GDP number. So I'll point to that in a minute. The correlation broke down a wee bit. I think it'll only be short term, but it just shows that New Zealand normally follows suit. But now we've actually, there's New Zealand, very much New Zealand centric factor, which has caused that. But the good news is that rates have come down from a QLDC perspective. So the next graph, and that is the GDP number. So markets are expecting 0.3% for GDP, and it came out at 0.9. Now that is a real, what we call an outlier, or as someone has sort of put it more bluntly, it was a shocker. If it came out at 0.4 minus, this was minus 0.3 and minus 0.9. If it came out at 0.4, that's okay. 0.5 is a wee bit away, but 0.9 is just a long, long way away. And it really did lead to interest rates falling. And it just showed the state of the economy. I've been travelling most weeks, you know, for the last month, 6 weeks, and just going around the country, and things aren't good. Apart from, well, it's a two-speed economy. I mean, it's basically Canterbury and South that's doing okay, and Queenstown, you know, is a wee bit unique because of the tourism. And Southland, I mean, I was there a wee while ago, and it's booming at the moment. Well, it's doing very well because that's dairy. But the rest of the country
Paying down debt and spending.
Yeah, there's just, well, I was talking to Southport the other day, and they did say that their import volumes are up and unseasonally, because it was farmers were there's more fertiliser and stock feed. So
They're going back onto the farm.
Yeah, there are some indications that maybe they're just starting to spend a bit on machinery. Farmers are starting to spend a bit. But the worrying one here is that lower blue line, which is GDP per capita. So the two straight lines are GDP and GDP per capita, and it starts at a base of 100 back in March 22. So while GDP did decline in the last quarter, it is above where it was in 2022. But you can see that GDP per capita has declined quite significantly, and that is a worry in New Zealand, and it really points to our lack of productivity. I think we're about 23rd in the world. Just to put into perspective, the US is 7 and Australia is 11, so we should be a lot better than what we are. So while the population's increasing, it doesn't seem to be adding to, well, it's certainly not adding to GDP in the way that it should be.
Well, it was immigration that was doing it.
Yeah, exactly.
And they were relying on that.
The next one, and this is another sort of slightly worrying trend, is that consumption is in the blue. Household consumption is in the blue line, and net household disposable income is in the red line. So normally, I mean, you would think that income should be above the consumption line, but it's below it now. And then in the grey line, you see the net effect of it, the grey bars. So there was a huge amount of saving over COVID because you couldn't spend on anything. But then you can see for the last 3 years that we've been spending more than we've been saving.
That's been there historically as well.
Yeah.
We're not savers.
No, and that shows up in the current account. Yeah.
But that's not necessarily discretionary consumption, but that's essential.
That's household consumption overall. Yeah, it's not broken down into discretionary and non-discretionary.
But I'm saying, would some of the driver of that be necessities.
Oh, yes, yeah,
Not just people spending more than they're making because.
No. no. We've got a client,
Probably the majority of it would be essentials.
yeah, or we've got a client who owns a number of shopping malls, and they were saying that it's very noticeable that the non-discretionary spend, the discretionary, the clients they've got on the malls who are discretionary, you know, travel, you know, high-end fashion is certainly declining. But the non-discretionary is actually, you know, that's holding up more, but people just have to spend on it.
I've seen the business as well. It's using up all their debt limits and using up all their reserves and stuff just to stay in business.
Mortgage arrears, credit card arrears, all up.
Yeah. Insolvencies are right up too. I think we're just about at record highs at the moment. One of our guys now, Auckland offices, fathers in insolvencies, never been busier.
Well, that's because the money dished out by the last government.
Yeah.
Through various programs that are never going to collect. So every time you see the inland revenues, the major.
They're the first one, yeah, and then the last ones they try and pay.
But that large amounts, though.
The next one. Now this might sound a little bit sort of oblique, but this is the GDP nowcast, if that means anything. But what it is that New Zealand has come in for a bit of criticism because we're the last country in the world to get our GDP number out. Ours comes out, well, we had ours, was it last, I'm trying to remember, last week before, and that was for the second quarter. All other countries get these out quicker, and I mean, by then it's historical. But I mean, this was such a shocker, and sometimes it doesn't have too much of an effect because the last one was so big, and it was so out of what was expected that, you know, it did move the markets. But what this is showing is that this is now the nowcast survey for the September quarter, and it is showing a bit of an improvement. And the interesting one is, the really interesting one is, oh, there is other. I'm not sure what that is, and we're just trying to work out what the national accounts are. We're not sure. That was only just came out this week. But the yellow lines are the surveys and the various surveys that the Reserve Bank look at, and that's like quarterly survey of business opinion, business confidence, consumer confidence, what they call purchasing managers index, you know, for manufacturers, so how much of purchasing managers spending to put through the factories, and in the services industry. And there was in August, there was quite an improvement in that in those surveys, but then you can see they've actually turned down a little bit now, you know, in the September quarter. The saying used to be survive till 25. Now the saying is survive through 25. So this so-called recovery that we thought would happen, well, you know, that was expected to happen, and it was really in the third quarter, starting the third, fourth quarter of this year. It's just not happening. So, but the good news is that they are expecting a positive GDP number this month, this quarter. Sorry, that's the blue line. Yes, the blue line. So we probably won't go into recession, but it's just whether or not it meets that expectation.
What are the chances of a revision of the 4 number?
Oh dear, you'd have to ask statistics to deal in that one probably. You're probably thinking to the US what happens in the non-farm payrolls data, yes, and the revisions. Just on that, one of the reasons why US bond rates came down, the biggest reason why, because US bond rates got to 4.5, now they're 4.1, the US 10-year, was the reaction to the non-farm payrolls data for July.
But then going back, they were all down substantially.
Yeah, so in July they revised. It was a worse number than expected for July, but the previous 2 months they revised down by 257,000. And President Trump's reaction, reaction to that was, well, you fire the head of statistics at the Department of Labor because of incompetence. I mean, I don't know if he was saying that the numbers are wrong, or if there was incompetence that you can't get it right. Now, as I understand it, the reason for it is that they surveyed about 70,000 firms for the non-farm payrolls data, but they only got, and it's not unusual, they only got 20,000 respondents. So they published the data, but then when the late respondents come in, they revise they incorporate into the previous month or 2 months to get a more accurate figure. So it's not the fault of the head of statistics. It's just the fact that it doesn't come in.
It's the fault of Trump's dodge. They fired a lot of the people, so they haven't got the resources any longer.
Yeah.
That's the main issue.
Yeah, but they have had previous revisions, and those revisions actually weren't anything unusual to what's happened under Biden and previous administrations. The next one. Monetary policy expectations. Now, this is pretty important. This is reasonably important for QLDC. I've actually got the latest one here, but what it's showing is that, I'll just check that this is the right one. The markets are expecting the OCR to go down by 25 points in October and then 25 points in November. That's pre the GDP number. That sort of shifted to, well, it's a wee bit hard. It's a wee bit hard. What it's actually saying now is that there is a 100% chance that it's going down by 25 in October, 100% chance in November. But what it's saying is that it's going to be at 225 by sort of April or May next year. So there's going to be, instead of 50, they thought 50 points would be the rest of the cut. Take the OCR to 250, that would mean 300 points of cuts since in this tightening cycle, the second most highest number of cuts since the OCR came in. The biggest one was in the GFC, which was 575. The next biggest was 175. But now they're saying that we're going to have another cut. But if you go to the next page, these are the bank economists. So that was the financial markets, how they are interpreting it. So, I mean, put in sort of simplistic terms, that's sort of the trade, the financial markets, the trading desk. These are the actual individual bank economists, which can change, which can be different what the trading desks are saying. So this now, and this was after the GDP number, so it's showing that ASB and Westpac are now expecting the OCR to go down to 2.25. BNZ and Westpac are, BNZ and ANZ are at 250, although ANZ is sort of wavering between 250 and 225 when they actually brought the announcement out. And that's and the dotted line is the Reserve Bank's projections, which are 250. Now, this is probably, this is quite crucial, is that when will we get 50 or will we get 75, and when will we get it? So we've got an OCR review in 7th of October. Oh, yeah, we've got it next week. And the markets are now thinking, some are thinking, will it be 50 this October? Because we've had this shocking number. And do the Reserve Bank have to show that, look, rather than just do 25, which is a little bit, it's a bit sort of wishy-washy. It's not a definitive statement, really. It's just 25. I think 50 would be showing a real commitment to showing that, saying we really have to get the economy going again. And we have to do something more meaningful in 25, and then they could do another 25 in November. Remembering that they review the cash rate every 6 weeks, but over Christmas it's 82 days. So just under 3 months. So I'm not sure if they can go, and if the economy is still in trouble, and we won't have the September quarter GDP data out before the November one, we will have the September quarter inflation data out, not before next week, but before the November one. I'm not sure that they can let the economy go through nearly 3 months if it's still in trouble and not be doing something, that's more meaningful than just 2 25-point cuts. I'm sort of favouring that we'll be 50 at these October or November meetings, and remembering that in the last meeting, that it wasn't, because it's a monetary policy committee and that's 6 members and each have a vote. It's not just the governor. And they voted 4-2 to drop it by 25. The other 2 said that it should have been 50, and this was before, sorry to keep mentioning this GDP number, but that was before that data came out. All we need is 1 more, and then it's the casting vote, and then 1 more, and it's a majority decision. I'm sort of leaning towards 50. Not everyone agrees with me at one of these next 2 meetings.
Is the counterfactuals inflation?
Yes.
Does the dollar will react to that?
that is, that, I think that's the data point that may stop the 50 if it goes up. They are projecting it to get closer to 3 and then to actually come down next year. Inflation's projected to come down. So I've been hurried up here, so I won't take too much longer. The next one, I won't worry about that. Then those just show swap rates coming down. All the lines are coming down, so that's interest rates all out to 7 years. The next one. That's the yield curve. So it's rates on a particular day from 3 months out to 10 years. On a particular day, the top one is where it was a year ago. And then the blue line, the solid blue line is where it is today. So you can see that short-term rates have fallen significantly over the last year, but long-term rates actually haven't come down that much, which has implications for what swap rates are getting. So when people ask, are rates going up, are they going down? Well, in this, you have to say, well, short-term rates are going down, but long-term rates are pretty much stable. But that is driven a bit by US rates. So the next one, I won't worry with that. So that's Queenstown Lakes debt cover position for October. It shows you're just policy compliant, but we have to do more swaps. But you do have a reasonable exposure to floating rates, and that's actually enabling your interest rate, your projected interest rates to come down. And it's actually coming down more than what we projected in the report, in the 16th September report. So if we go to the next one, those are the rates that you'll be getting if we did 3 swaps. Now, so these are starting in October 27 and April 27, going out to November 30, May 30, and May 31. It produces the dotted line, and so that means that you will be policy compliant as soon as we did those swaps. Now, we've left this as long as possible because next month November you won't be compliant, but it's been deliberate, and interest rates are actually at 3 3/4 year lows in New Zealand. So it has been the right strategy to adopt, and you're getting 342, 343 and 349. I won't spend too much time on Catherine, this is the important bit, so 3 or 4 more minutes, fine. I'm talking as fast as I can. I did have a meeting with Paddy and Catherine and so I'll just go back one. We could have got you lower rates, but that would mean that those swaps would have started in 2025. Now those rates would have been, well, the 5-year rate at the moment is 310. So those rates would have been lower, but it means that you would have an immediate increase in your cost of funds because instead of the floating rate, which is 278, I think today, and will probably go lower, you would go up immediately. And so the question was, do you want the benefit now, but the cost later on? And that's the strategy, which was the one that was preferred. Or do you want the benefit? Do you want the cost now and the benefit later? So this was the option that was preferred. The one important point to note in this is that it does keep your cost of funds low. It keeps your cost, it keeps your exposure to floating rates. And it actually is, those swaps will start at a time when the OCR may be going up. When the OCR bottoms out, it normally stays at the bottom for 12 to 15 months and then starts going up. So this is actually the perfect time. And I think a rate of 350, that's a swap rate of 350, you put your margin on top of that, that's 4%. And I think you get a little bit 4%. So this is where I've been getting to for the last 10, 15 minutes. But this is what we have to do. And the last one, I think it's the last one, that does show you cost of funds. So that's the red line. So we are at the bottom of interest rates, but it does come down. I think I looked at it yesterday, it was about 378 it comes down to, but you don't actually go up that much. Whereas the floating rate, which is the bottom mustard coloured line, is going up quite sharply. You're not. And that's because of what we've done with the swaps. So that's me.
Okay, thank you. Any questions? No. Okay, well, thank you for that. We'll note the contents of the report, so I'll move that. For the second, Bill, all those in favour? Carried. Thank you.
Miles.
So Patty, you're staying there?
Yeah.
And we've got the annual report. Thanks, Miles.
Thank you.
Heidi?
Oh.
Okay,
Right, so it's annual report time again, so got Deloitte here to just explain their audit report and to go through their findings. And then ultimately for the committee, we're looking for a recommendation to go to council next week to adopt. So over to Heidi now to explain.
Morning, everybody. Look, I'll take the report as read, but I'll touch through a few things just in terms of highlights or things to call out in that report. Apologies, I just have a slight tech issue that my laptop's restarting, so while I through that, luckily I've got a paper copy in front of me, so I'll talk to that, but feel free to jump in and ask me questions along the way. I guess probably the main things to talk about is that in front of you, there's no changes in terms of the areas of focus or things that we called out from our planning report in terms of the final audit. So all the areas that we've got in there were things that we touched on as part of that. The status of the audit, I can update a little bit from what's in front of you. Basically, we're largely complete in terms of our substantive procedures. They're all done. I'm aware there's a couple of very minor changes to the financial statements that are getting made today, and that will be that effectively done. And then that really just leaves us in a position of just completing subsequent events procedures, which are normal, just as we always do those right through to signing. So that will be through to next Thursday. So I guess we just have to be aware that if anything came up in that period, we would have to consider it. So that's, yeah, essentially that's the status. In terms of areas interested on that executive summary page, there's just a few items on that right-hand side that I'll just touch on. One was just the vested assets restatement. So there is a restatement in the financial statements part of the annual report this year, just in relation to 25 million of vested assets that were really identified that should have been recognised from 2021 to 2024. So there's an impact on the prior year figures and also on the opening balances in relation to that. The shot over wastewater, there is a provision in the financial statements. So we see there have been issues around that particular wastewater plant. An assessment was done around impairment in the current year. The carrying value of that asset was 5.6 million and a provision's been recognised for 2.8. So essentially there's 2.8 value still sitting in the financial statements. Just calling it out because it is a judgment, and I think the reason why the whole amount hasn't been written off is the assessment has been done that a portion of those assets that remain can be reused, particularly around pipes, I believe. So I guess calling out that in the event that that reuse doesn't happen, then we'll need to revisit that impairment in future periods. Just classification of properties as a judgment that I think just flows through the financial statements, and it is called out in the current year, but just really highlighting that there is definitely judgment about where particular properties need to sit, and there is a range, I guess, across property, plant, equipment, investment property, development property, and also in held for sale. So just realising that there is, I guess, a range of things sitting across those different aspects. And also probably the leaky home provision is in one of the better situations it's been for a long time, I guess, for this council. So there were two that were had a provision at balance date and have subsequently been settled. I just touched through each of the sort of the main areas in the report. So property, plant, and equipment is a significant risk in our this year, mainly around the valuation of the roading assets. You'll see there was a $57 million uplift in relation to that those assets, predominantly driven by reassessments of unit rates as part of the normal process the valuers do, and also in alignment with recent contracts of council's own contracts, and also they look at a range of other councils to kind of get alignment across those. So that's probably the main one. There was no significant issues that came out of that process. There's a material movement assessment done of the three waters assets, infrastructure assets, and there was no material movement identified, so no valuation in the current year for those. Statement of service performance. This is the first year reporting against the 2024-2034 LTP measures. So there will be some that will have carried through that you will have seen previously, and some new measures in the current year. Just calling out a couple of things that have happened this year that are perhaps a little bit different. There was a few things that came out relatively late in the piece, not necessarily council's own issues, but that came out nationally. So the smooth travel exposure data guidance came out from NZTA that there was some inconsistent data in what was being provided for that measure, not considered to be significant at all, but there were sort of two options, basically to rerun the data at a later date, but it is at a point in time, so you would have ended up with a measure run basically in September rather than at 30 June, or just to put a footnote in that there was an update subsequently, but it would have had minor impacts. So that footnote's been included in the report under that measure. Request for services, it was identified that not all of them have been processed in relation to the end of the year and hadn't been completed during the audit. So I'm aware there's just 6 that are left that haven't been completed at this point in time. That can't have a significant impact on the number, given the sort of thousands that do get processed during the year. So comfortable that it's not going to have a significant change to the measure that's reported. And the new drinking water standards came out during the year. Obviously, that was subsequent to the measures being put into the long-term plan. So there has been some measures that are included that have been reported against in the annual report as the new measures, the new rules. There is some guidance that again came out quite late in relation to what was expected for reporting against those. Not all of those have been able to be captured in this annual report, just given timing. It was literally a week ago, wasn't it, Catherine? It was quite unhelpful. So we have included as part of the representation a sort of a disclosure, just sort of an omitted disclosure, I guess, around those, the fulsomeness of their guidance around those measures. So there's still, complete disclosure around each scheme, but just not some of the further detail that would have been asked for by the DIA. And that can be looked at for going forward, I think. Touching on rates, just a minor thing, well, not minor, but we did notice some small differences in just a handful of rates, mixed use rates, between the resolution and what was processed. So we just called that out, that we understand it's going to be changed, but in each case, the rate payers were undercharged. From a group audit perspective, obviously, Queenstown Airport is consolidated into the council's group statements. And just to call out, so I'll talk on it a little bit further on, but in terms of our audit opinion, we will have unmodified opinions, so no qualifications, but we will have 2 emphasis matters. One of them will flow up into the group accounts that relates to Queenstown Airport. The airport itself had an emphasis matter just around the provision that it had made for the Lot 6 assessment had gone through the Land Valuation Tribunal earlier this year in April. The decision from that has yet to be made. Hopefully it doesn't come out in the next week. We need to think about it, but no. So essentially there's a provision there, but given there has been no decision made, there is uncertainty around what might be required to settle that in the future. So just calling that out as an emphasis. Management override is a significant fraud risk for all audits. So really just touching on there in relation to a control area of recommendation for improvement, that just at the moment, from a review of journals perspective, it's only in relation to journals over a $10 million value, which we consider too high. It's higher than our audit materiality, so it wouldn't identify a risk for a material fraud item.
So that's something that's been picked up.
Keep moving through, touch on sensitive expenditure, which this is part of being an audit for the Auditor General. We do focus on areas of property and waste. We look at samples across a range of different things, including elected member expenditure, chief executive, key management personnel, a number of things. We just touched on a couple of points there around some timeliness of claims from the councillor, and there was just one in relation to the chief executive, where it was just an item outside of delegation, which was then once identified had been retrospectively approved. Local audit done well. There is quite a disclosure in the subsequent events note around where things are at this point in time. I guess the other emphasis matter that's going into the audit opinion is just around the fact that where you are in terms of status of your water services plan and delivery plan, sorry, has not been approved yet by the Secretary of Local Government. So there is some uncertainty as to where that goes from here. We keep moving through. There are just a couple of unadjusted differences that you'll see in the report, both in relation to prior year items that have been identified in the current year material, and some admitted disclosures on the following pages as well. The vast majority of those are ones that have been included in previous years. Just a few new ones in the current year to just touch on. Expected credit losses is just around some of the information around assumptions that go into that provision. There is one I touched on around water rules, which is not in the pack in front of you because it came out so late, but we will include one in the final that will get updated today around the water rules and just including all the guidance, the disclosures from the guidance from the DIA. Prior year imputation credits disclosure, which is just in relation to an accrual for the imputation credits on the QLDC dividend, and just a contingent liability just associated and that's really that in a nutshell.
Heidi, just in the rep letter, there was just a couple of points there.
Absolutely, sorry, just to call out. So there's a couple of things that are probably new in the representation letter that you may not have seen before. On the first page, sorry, apologies, I haven't got it in front of me, but about halfway down, there's two paragraphs that I believe start with "we understand." Yeah, the second one just there highlights because it's a non-standard audit report, the Auditor General may refer to this in some of its reporting. So essentially the two emphasis of matter may get called out in some of the Auditor General's reporting. This is very normal in terms of what happens in terms of whenever there's an emphasis of matter, we have that. If you go to the next page, about just above the heading that says some representations about the provisions of information. Just above that, it's just pulling out the restatement that I touched on earlier. And then over the page, there are some specific representations. Again, some of those you'll have seen before, but it does just highlight that judgment around the shot over provision, the wastewater plant provision, impairment, brings in the Queenstown Airport provision around the lot 6. That I also touched on, and also evaluations have always been there previously, and contingencies have always been there previously.
Okay, very comprehensive report, so thank you. Any questions at all? If not, we'll note the contents of the report. We'll note that Deloitte have presented its audit report at this meeting and recommend to Council that the 24-25 annual report be adopted. Got a mover? Bill? Gavin, you're second? Yep. All those in favour? Yeah. Thank you, Heidi. And Caleb.
Thank you. Happy to be here. Yeah, thanks, Mike.
Right. Health and safety, Gavin. Morning.
Morning, through the chair. If you don't mind, I'd like to highlight 3 points from the report.
Yes, thank you.
First of all, over the reporting period, there was excellent attendance and feedback at the series of financial wellbeing workshops. The reporting period also saw the release of the 2025-26 wellbeing calendar from the organisation. Second, there were 2 lost time injuries over the reporting period, although the lost time injury frequency rate decreased to 6.6, which is below the KPI of 9. And thirdly, I've noted that all 13 objectives were achieved on the KPI indicators for the year ending June 30th, 2025. Thank you, mate.
That was good. Getting those, achieving those. I'll just open up for questions.
Well, I guess my question is more prospective. I've got the report for the objectives for 24-25. What are you anticipating might change in 25-26?
Some of these KPIs were hardened up this last time around and we introduced new ones.
Yep.
So what we like to do is, rather than, oh, we did it for 1 year, we want to continue it, sort of thing, because then they remain in the, how do you put it, the BAU, and then we'll change in another couple of years, sort of thing, so that we get people into the swing of that's just what we do. One of the things was the encouraging reps to get out and about within their offices, do inspections, fire extinguishers are the signage up, is the AED working, that type of thing, and also going out to the facilities with other reps to another set of eyes, but it also shows them the operations in those areas. And that was a thing we started this last time around. But one of the things that we've actually really benefited from it, been able to sort of say to, hey, property, we're missing this fire extinguisher, or first aid's not been checked in a while and things. So we want to get that to be a sort of a BAU thing before we change anything like that. And it's the same with some of the other ones as well that we introduced this last time around.
Yep. It's a very good review of what you've achieved. And I was thinking probably in terms of the culture, the prevention improvement objectives, probably where the real oil is in terms of they're just thinking, will you do anything differently? Actually, what you're doing. So,
well, the other thing is at our committee meetings through the year and things like we pick up things and then we'll have a discussion. Sort of, well, that actually might be a neat thing to do, sort of thing. One of the ones this year was actually concentrating more on the wellbeing calendar, because we've got Jenny who's specifically sort of looking at that now. So where the committee had their wellbeing calendar, we kind of monitored that for this year, but with Jenny putting all her new stuff in, which has become very, it's very popular sort of thing. So that was a kind of focus for this last year on getting a better wellbeing calendar together that, more people can take part in lots more different things. So, yeah.
Might be also, this year, the year gone, was the first time we formally did a wellbeing survey.
Yeah.
We used basic on our Gallup system. We got really positive response to that. So that's been, we're now able to benchmark some of those wellbeing things in a way that we couldn't before.
In terms of other TLAs, are you part of a peer network?
Sorry, pardon?
In terms of TLAs, more generally, are you part of a peer network where you share good stories and war stories in terms of the self-improvement?
Through the chair, absolutely, we do have a strong peer network. So through the Health and Safety Forum, also through Site Safe, Site-Wise, also through other local councils as well. We've got a really strong health and safety network. So it's good to have a benchmarking comparison.
So, thank you. Any other questions? If not, we'll note the contents. Sorry, we'll get the right one. Note the contents of the report. So I'll move that.
I think it's probably noted and looked at all of them
achieving all those KPIs was excellent. Yeah, I was going to mention. Yes, so thank you. So I've moved. Got a seconder, Bill? All those in favour? Carried. Thank you, Katie, John, and Alan.
Thank you, sir. Tēnā koutou katoa. Thank you for the opportunity to present today our latest report on the climate risk plan for you. We'd like to acknowledge the service of the committee and also this is the last meeting of the triennium, so free service. Through the chair, I'd like to just provide some framing for the report and the attachments that you have for you today. As the committee will report, Council adopted the latest climate biodiversity plan in late July. Alongside this adoption, there was a resolution to direct staff to provide updates to full council on delivery progress every 6 months. This is an opportunity to increase the visibility and transparency for full council, but also opens up the space to look at a more targeted climate risk focused reporting for the Audit, Finance and Risk Committee. Today's report marks the first step in discussing this shift. The report outlines the context of these changes and highlights some of the recent work that we've undertaken to align QLDC with emerging best practices around climate risk reporting. These standards are mandatory for a number of financial insurance providers and publicly listed companies, and we're seeing a growing shift towards climate risk disclosure around in the public sector setting. The reporting shift that we're exploring should allow the Audit, Finance and Risk Committee to receive a more targeted updates regarding the district's climate risks and opportunities associated with the transition. One of the key steps include good climate governance is the assessment of potential climate risk or climate scenarios. And the organisation has been making some very strong progress in this space through supporting a national program around looking at climate risk scenarios for the local government sector. The attachments within this report provide you with some insight into the outputs of this program, and QLDC will be looking to see how we can take those forward in terms of localising those scenarios to support the strategic decision making around long-term plans, investment infrastructure strategies, and looking at the climate risks associated with the council's activities and services. The work that we've undertaken has been led by Wellington City Council and the Local Government Funding Agency, who are subject to climate risk disclosure requirements. Yes. And QLDC was the sole South Island representative on that working group. The scenarios are an important tool for the sector, and we certainly hope to look at progressing those. And I'm working through a program of activity to look at how they can support good climate risk practices within the organisation. The report before you also provides some updates on the work that's underway with regards to change management, greenhouse gas emission reporting, and the important intersection that we have between Gareth and Bridget's work in the insurance space. So we're happy to take the report as read and open the floor for any questions.
It's more prospective for the new triennium. Obviously, it will be a significant change in terms of the focus of this committee. So, I suspect whoever is on the committee, particularly the independents, getting a good briefing around the framework and how it's going to operationalise in terms of the assurance function of the committee would be really helpful. Excellent.
Just a quick one, just interested in one thing he said, that QLDC is the only South Island council involved in the assessment. But what are the other councils doing? Are they doing something different or nothing?
The work that was through the chair, so the work that was underway around creating local government sectors, it was led by LGFA. So the call for support in terms of representative councils was made. So ourselves, as well as about 8 other councils, supported the working group, and over a period of about 4 months, we helped to develop work programs, the workshops, and those workshops there were participants from councils all around the country. So essentially, we were in the steering group, for that work program. The focus of it very much was around creating a toolkit that will be available for the entire local government sector. It was acknowledged that every council doing this independently made little sense. And certainly there are some economies and best practice around coming together as a sector to develop scenarios. And this is what's happened in many other sectors across the country.
Okay, thank you.
Bill, your work, just going back a year or two ago when I joined the Auditor General, they have a session once a month for chairs of Audit and Risk Committee. And it came up there that you're a leader in the sector with your work. And so the work that is in this paper here is a bit of qualities I've seen in the public company area. So well done. So
It's much appreciated.
a very good report. So on that basis, unless there's more questions, I'm happy to move that we note the contents of the report and note that in the new triennium, there will be a recommendation to change reporting to a 6-monthly climate governance reporting framework. The Climate and Diversity Plan Program updates be provided to the full council on a parallel 6-monthly cycle. So we're going to move, Bill, Gavin, your second. Yep. All those in favour? Carried. Thank you. Great work.
Chair, the real work is still on either side of.
What was that line?
The real work is still on either side of the bill here.
Yeah, absolutely.
Yep. Thank you very much. Cheers.
Paul.
Morning.
Morning.
Would you like a lead in based on changes from the last reporting, or just we can take it as read?
We can take it as read, unless there's something more you want to share with us.
Well, in terms of from last time we spoke, the developer had a workshop with council on the 19th of August. At that meeting, they had the finance team in the room and the construction manager. And they indicated that they'd be looking to start work before the end of the year. Since then, well, as part of that, all the information provided by the developer since then has gone through we've been going through a validation exercise with that information, and all the financing, construction, consenting, and their program is consistent with what they've been telling, what they told the councillors. So the information backs that up. They've satisfied some conditions, and there are some outstanding conditions that we're still working through in terms of validation, but in terms of any further information from the developer at this point, we're pretty comfortable with where that sits. And accordingly, the developer's obligations, table 2, we've reduced the risk from a medium, I think, in the last reporting period for the satisfaction of the stage 1 settlement conditions to a low risk. And in particular, their fixed settlement sunset date being April next year, where that's gone from a moderate to a low risk at this point. And the only other change, I think, in the previous reporting, we had a table with a full breakdown of all the council works and all that. I think that was missing in the last report, so we've added in just an update there on the financial implications on paragraph 15, the spend to date on the subdivision works, just to clarify that point.
Bill, thanks. Paragraph 8 talks about all the towards the construction committee stuff before the year. That sounds like a significant milestone.
We'll be a bit happy.
Yeah. So what does it actually mean in terms of commencement? Is that physically turning over soil?
Yes. Yeah. The prerequisite to that, of course, is settlement. So exchange of title. But yes, and there is a significant civil works package leading into that. The developers not only working on their lot, but some of the future stages and enabling as well as part of that initial civil works package. So they're pretty committed, obviously, to not only the first stage, but future stages. Yeah. Well, at least they're taking that mindset with their approach and with their wallets.
Yes.
Yeah.
More importantly.
Yeah. And just to remind the committee that this is a progressive sell down lot by lot based on development performance. So we're only talking that the first lot, but this is first 2 lots.
They're doing the enabling works for the first 2 lots, but their first major investment package is over 200 million is in the first package. So in the context of the economic environment, I think if you go back to the business case for this particular project, in terms of working through economic cycles and having that long view, it's quite exciting to have that sort of investment going into this market currently.
It is. Kevin.
Yeah, I was going to say, so there's obviously a lot of speculation out public about the project and how it's progressing and various values involved, return from to the table that's in the report here, obviously it's public information as part of this meeting, so that it's a bit of clarity on some of that. I just wanted to check, I guess, I mean, there's some commercial sensitivity, I guess, in the development agreement itself. That's confidential, isn't it? Because of that reason, it's not out public. But yeah, it's good to see those figures here, so thanks for that. And also, I was going to say the workshop was really useful as well. We had with the,
Found them useful, yeah.
Yeah, that was the upshot from the review, and part of this reporting, so the two things that came from that, in the governance review that happened 3 years ago. So the 6 monthly updates, with the developer directly with the council, and of course this reporting as well.
Yeah, thanks, Paul. Appreciate this. And I think everyone's aware, I articulated some questions prior to this meeting.
Yes.
And I've had some feedback on that. Great to hear that. So in my understanding, just to reiterate, is the developers got the information across to us, and it's now on QLDC's table to work through that validation plan. That's fantastic. To see some work started before the end of the year would be amazing. So yeah, just then my question to you, Paul, just to reiterate, I'd like to see council making a priority to get that validation piece done and across and get to that second. But yeah, thank you very much. And thanks for the feedback that you gave me on those questions because we have them.
Oh, yeah, thank you, Heath. Any further questions? If not, we'll note the contents of this report. We've got a move that with. And second as well. All those in favour? Carry. Thank you. Thank you, Paul. Next one is the sale of surplus elected member iPads. Well,
Chair. That's not up with the conflict.
yes,
So
you raised that.
sit here and be quiet.
That's fine.
Thanks. Thanks very much for this one. Generally, it's standard practice every triennium that we provide elected members with a new device for 3 years ahead. And at the tail end of that process, as part of that cycle, we look to offer them up the sale of the devices at the end of the triennium. With the election just about upon us, we're at that point in that process. It's a fairly standard thing we've done for quite a number of years. We do it in keeping with the sensitive expenditure policy, which requires that they are offered up at no less than market value, determined by an appropriate valuation. Knowledge management team has done a scan of what's out there for the appropriate models. We've come back to sort of reasonable average of the two models that we've got, which is what's presented.
Okay, that's fine. I've got no issue with them. Everyone happy with that? So we'll note the contents of the report and approve the sale of the surplus elected member IP tablet devices to elected members at the end of the 2022-2025 triennium at no less than market value is required in the sensitive expenditure policy. So I'll move. Bill, your second. All those in favour? Carry. Thank you. It's done. Right, I'd like to move now that the public be excluded from the following parts of the meeting. And I've also moved that Heidi, audit from Deloitte, remain in the meeting during the public excluded session because of her role as external auditor. And there's the confirmation of the public excluded minutes of the 8th of July. Item 9, internal audit report October 25. Item 10, cyber security update, and item 11, legal update. So you'll move second.
Just check with Heidi. Is Hannah in the meeting? Okay, so perhaps we just let Hannah. Thank you, Hannah. If you can drop out, that'd be great as we move into the hearings.
Stop recording, restart.